Around the world, stock markets fell faster than a skydiver without a parachute.
When the stock market crashes, where does the money go?
In just a few hours, 13 million stocks were suddenly dumped on the market by panic-stricken shareholders. The cumulative losses amounted to $30 billion.
I'm expecting a stock market crash. We've got an AI bubble that's primed to burst, increasing joblessness, wealth inequality rising to unprecedented levels, geopolitical instability, and a madcap tariff policy. It's all pointing towards one thing. But when newsreaders announced that billions of dollars have been wiped off the stock market, where did all that money go?
Down 1.7% here, a loss of 37 points or so. Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate.
The answer is, it didn't go anywhere. Let me explain. Imagine for a moment that the stock market is the avocado market. Imagine there are 1 million avocados available for sale, each of them at the price of $1. That would make the total value of the avocado market $1 million. Now, imagine that one shop decides to sell its avocados for 70 cents instead of $1. Now, all the other shops have to follow suit, otherwise they get undercut on price. So now, there are still 1 million avocados in the avocado market, but since they're now priced at 70 cents, the total value of the avocado market is $700,000. So, did $300,000 magically disappear from the avocado market? No, it never existed at all. The $1 value attached to each avocado was simply a measure of what each shop hoped avocados would be worth. But until you've paid that price for an avocado, there's no proof that that price was correct. Now the new hoped-for price is 70 cents. The market has spoken and decided that's the new price of avocados. Well, the same thing happens in the stock market. If $300 billion is lost from the stock market, that's because people are no longer willing to pay the previous price of shares. The market has settled on a valuation which is $300 billion less, a new price which people are willing to pay. No money has actually disappeared. The only thing that's changed is the expectation of how much you would get if you sell your shares. In this sense, stock market values have nothing to do with the amount of money in them. They're a measure of how much money you would hope to get if all the shares sold. In other words, that value is just a guess. When the market falls, people still own the same amount of shares, or, choose our previous example, the same amount of avocados. They'd just get less money if they decided to sell their shares. But if everyone flocks to the shops and starts buying lots of avocados again, the shops might be able to put the price of avocados back up to $1. Or, if that trend continues, they might put it even higher, to $1.10. The point is that markets aren't built on exact prices. They're built on confidence. Confidence rises and falls, depending on people's expectations for the future. When people have high confidence in the future of the avocado market, avocados' prices will go up to reflect that. When people have low confidence in this future, the price will go down. Stock market prices move quicker than avocado prices ever would. That's just the nature of stock markets. They're constantly repricing themselves throughout the day. When people want to buy a share, they place bids for the price they're willing to pay. When people want to sell, they list offers for the price they're willing to accept. The stock exchange automatically matches buyers and sellers. The last price a trade happens at becomes the new share price. It's automatic in the sense that computers match the trades instantly, but the reason prices change is because humans and investment algorithms are constantly making decisions based on news and expectations. If a company starts making more money than expected, launches something popular, or looks like it will grow a lot in the future, investors get excited and the price goes up. If it loses money, faces bad news, or the economy looks weak, people get worried and the price goes down. Things like interest rates also matter. When rates are low, investing in shares looks more attractive, so prices often rise. When rates are high, prices can fall. In simple terms, share prices move because expectations about the company's future keep changing. When there's a market crash, there's only really a big loss if everyone decides to sell in a panic. That's when massive cash losses happen. That's what happened during the Great Depression of 1929, and to a smaller extent in 1987, and during the 2008 financial crisis. Historians estimate that during the Great Depression, trillions of dollars in today's money were lost. Panics are what cause money to evaporate. If people waited out the panic and didn't sell their shares, they wouldn't incur the huge losses. Market crashes are about emotion, not the physical exchange of goods or services, or even money. They're just about people's hopes for the future, which they sometimes get wrong. And when they do get them wrong, the stock market falls. And here's the secret. When the stock market does crash, that's the best time to buy. Look at this graph and you'll see big drops every few years, particularly in 2008, the pandemic, and 2022, all triggered by fear and sentiment. You can take advantage of discounted stock prices so that when the market rises again, which history shows it inevitably will, you can make a profit. But predicting market movements isn't easy. Knowing when to act often takes careful research and insights from experienced investors. Quick disclaimer, I'm not a financial advisor and this isn't financial advice. I invest the same amounts every single month whether the market is up or down. That consistency helps me ride out volatility and benefit from the market's long-term upward trend. I also follow the 50-30-20 rule. 50% of my income goes towards necessities, rents, mortgage, food, bills. 30% goes towards lifestyle spending, dinners out, travel, experiences. The remaining 20% gets invested. You can watch this video to the left of me here if you want to understand the AI bubble that looks set to burst immediately, or this video to the right of me to understand why gold has surged to record amounts in the last year. Unlike your stocks and shares, these avocados look good enough to eat. Thanks for watching. See you on the next one.